In just 1 week, China reshaped the global trade landscape without saying a single word. Rare earth exports to the U.S.? Gone. Ports like Los Angeles, already struggling with a 30% year-over-year drop, just hit their lowest cargo volume since the 2020 lockdown. Treasury Secretary Bessant is out front, insisting the U.S. economy is stronger than ever, but behind closed doors, he's reportedly scrambling for a call with President Xi. Meanwhile, the dollar slipped below 99.2 for the first time in 2025. Bond yields are surging. Foreign investors are pulling billions out of U.S. debt markets. This isn't a standoff, it's a silent chokehold. Beijing isn't issuing ultimatums or holding flashy press conferences. They're quietly turning the screws, using supply chains as a weapon. According to Reuters, China has once again tightened restrictions on rare earth exports, cutting off access to 70% of the minerals critical to U.S. industry.
The U.S. military needs rare earth minerals to function, but China's recently imposed restrictions on their export is raising national security concerns.
There's been no official ban, no fiery press release, just a quiet move, export licenses left to expire, and a 19% drop in rare earth shipments in a single month. According to the Financial Times, suppliers in Jiangxi have paused exports to unfriendly markets. China hasn't slammed the door, it's letting it creak shut. Here's the reality. China controls 87% of the world's refined rare earths and nearly 100% of the heavy ones. These are the backbone of electric vehicles, defense systems, advanced tech. Tesla Raytheon, one tweak in a customs code, and the U.S. is scrambling for workarounds. On May 31, 2025, Washington extended Section 301 tariff exclusions on Chinese goods, smartphones, semiconductors, medical gear through August. But what's getting less attention is the unraveling underneath. While Treasury Secretary Bessant was on Face the Nation accusing Beijing of economic coercion, he was also pushing for high-level talks without offering a single rollback in return. You can't threaten your supplier and ask for a discount. Meanwhile, Trump's doubling down on reshoring chip fabs. But the question looms, what happens when China still controls the raw inputs? Washington isn't backing off either. The Bureau of Industry and Security just tightened restrictions on AI chip design software, think Synopsys, Cadence, barring access for Chinese developers. The Wall Street Journal reports new secondary sanctions are coming for allies buying Huawei's 7-nanometer chips. Senator Marco Rubio is even pushing to revoke visas for over 300,000 Chinese students. Bessant calls it derisking, not decoupling. Beijing's not buying it. Their Ministry of Commerce told state media they'll hit back hard against what they see as violations of the May truce. At the port of Long Beach, CEO Mario Cordero told CNBC not a single Chinese vessel docked last week. It was the worst traffic since early COVID.
What we're looking at is less vessel calls to the port of Long Beach, which means less cargo volume, which means less products that could eventually not be on the shelves.
Importers aren't counting on stable policy anymore. Can you blame them? Trump's 145% retaliatory tariffs have been in effect since May, and the costs are already landing on the table. This trade war isn't theoretical, it's happening in real time. So who's really in control here? China's export office, or an America losing leverage by the day? This isn't diplomacy, it's a slow-motion financial wreck, and the cracks are starting to show. Take coffee. Prices have jumped 17% in just 3 weeks, according to ICE Futures. Colombian beans, which make up nearly a third of U.S. imports, are now facing steep new duties. At the same time, the U.S. dollar index has tumbled over 10% from its 2024 peak of 110, now sitting below 99.2. That wipes out returns for foreign investors holding U.S. debt, and they're noticing. Bloomberg reports the once mighty yen-carry trade is unraveling, with Japan's 10-year yields hitting 1.5%, the highest in over a decade. Economic gravity is pulling everything down. But you wouldn't know it from Treasury Secretary Bessant, who keeps pointing fingers at China's problems while glossing over our own. Right now, we're paying 4.8% to borrow for 30 years, a 73 basis point jump in just 2 months. So who's really defying gravity, and how much longer before the debt bill comes due? On May 30th, the U.S. 5-year Treasury auction saw its weakest foreign demand since 2019. Indirect bids dropped to 56%, a clear sign the world's getting cautious. Meanwhile, 30-year yields spiked to 4.98%, signaling that faith in America's long-term financial outlook is eroding. Bessant went on CBS, assuring everyone the U.S. would never default and that the debt ceiling would be raised without issue. But when pressed for a deadline, he ducked the question, even though the Bipartisan Policy Center projects a cash shortfall by mid-August. Moody's recent downgrade didn't mince words. Rising debt, political dysfunction, and fiscal indiscipline are all flashing red. For bondholders, the danger isn't just missing a payment, it's losing value. A 10% drop in the dollar erases the yield advantage, especially for international investors. The result? Yields keep rising, bond prices keep falling, and buyers start disappearing. And if confidence is what props up debt markets, Washington's running dangerously low on it. On May 31st, J.P. Morgan CEO Jamie Dimon issued a stark warning at the Reagan National Economic Forum. The U.S. bond market is just one policy mistake away from cracking. He pointed to unchecked fiscal stimulus and post-COVID quantitative easing as the main forces weakening a Treasury system now buckling under a $2.5 trillion deficit expansion. The national debt has already crossed $37.1 trillion. Treasury Secretary Scott Bessant shrugged off Dimon's warning, dismissing it by saying none of his predictions have come true, but the numbers say otherwise. Bloomberg data shows foreign holdings of U.S. Treasuries fell to $7.4 trillion in April, down $110 billion in just 60 days. That's not an opinion. That's capital walking out the door. Bessant continues to insist the deficit will shrink over the next 4 years. But the Congressional Budget Office tells a different story. The 2025 fiscal year deficit already hit $1.02 trillion by April, up from $860 billion this time last year, and with a massive spending bill still awaiting Senate approval, Moody's analysts now expect the debt ceiling to rise another $4 trillion by year-end. Dimon's not just speculating, he's diagnosing. Bessant's response isn't a plan, it's a sales pitch. And the problems don't stop at debt. Back in January, Bessant and former President Trump promised 90 new trade deals in 90 days. 5 months later, there's only one, an agreement with the UK, and even that hasn't moved the needle. The Port of Los Angeles reported 0 cargo departures from China on May 10th, a collapse not seen since the supply chain crisis of 2020. Retailers around San Pedro Bay are already facing shortages in electronics and key raw materials, while Chinese suppliers in Shanghai are stalling new procurement contracts over tariff concerns. Axios confirms Beijing has paused all tech shipments not tied to long-term deals, citing continued policy uncertainty. U.S. trade officials downplay it as a temporary blip. But again, the data tells a different story. Walmart raised prices between 3.4% and 4% in May alone, citing rising shipping costs from Asia. Meanwhile, the Institute for Supply Management reported a 6-point drop in new U.S. manufacturing orders, the sharpest decline since 2022. This isn't just a trade dispute, it's an economic gut punch, and if new trade agreements don't materialize by Q3, the supply chain squeeze will start hitting store shelves across the country. Bessant claims China's absorbing 65% of the tariffs, pointing to a 2019 NBER study, but U.S. Customs and Border Protection reports $177 billion in tariff revenue since 2018, while the Peterson Institute finds consumer prices on tariff-affected goods have climbed 11.3% on average. In May 2025, prices on Chinese-sourced electronics jumped 4.8%. Retailers like Walmart, Best Buy, and Dollar General are already passing those increases directly to you. Treasury Secretary Scott Bessant insists Chinese exporters are eating the cost, but the numbers tell a different story. Chinese shipments to the U.S. aren't rising, they're falling. Companies like BYD and KTL are shifting production to Africa and Latin America just to dodge the tariff hit. Meanwhile, U.S. importers are stuck signing short-term contracts at 20-30% markups, terrified the next tariff hike will drop mid-shipment. The American Apparel and Footwear Association says landed costs surged 18% in Q2 alone. If China were really footing the bill, we'd be seeing a flood of exports trying to protect margins. We're not. So, who's paying? You are. And now, inflation data from the Bureau of Labor Statistics is catching up. Bessant keeps repeating that the U.S. won't default. And he's technically right, but a missed payment isn't the only way bondholders lose. Inflation, currency devaluation, and poor maturity timing quietly eat into returns, even if every payment arrives on time. Look at the latest Treasury bond auction. 30-year yields hit 4.98%, while 5-year notes are holding steady at 4.23%. That's a yield curve screaming long-term uncertainty. The Federal Reserve reports foreign demand for long-term U.S. debt fell 14% last quarter. Japan and China alone dumped $48.7 billion in Treasuries. Now Moody's is warning of a possible U.S. credit downgrade, citing deepening policy instability. That's not just a red flag, it's market fear. Bessant dodging debt ceiling deadlines isn't clever, it's damage control, an attempt to avoid triggering a bondholder panic. But investors aren't waiting around. They're shifting to shorter maturities. Because while the U.S. may not default on paper, the value of that paper is already fading. Inflation's quietly eroding it. And unless something changes, that erosion isn't stopping. So here's the big picture. China's slowing exports, collapsing cargo volumes, rising U.S. borrowing costs, and a Treasury Secretary caught between political spin and market silence. Who's really steering the ship? Bessant's betting on optimism. Wall Street? It's already hedging short. Beijing isn't making headlines, they're making moves, strategic, quiet, and effective. Meanwhile, U.S. consumers are already picking up the tab. So here's the question. What happens if we raise the debt ceiling, but investor trust doesn't rise with it? Let me know what you think. Is this just another rough patch in the cycle, or the start of something deeper? If you found this helpful, hit that like button, subscribe, and check out the next video right here. Thanks for watching.